Welcome to this edition of The Debate on France 24. I'm Andrea Sankey in Paris. Tonight, how secure is the state of our global markets? Now, we may have seen worse before, but recent market volatility has made many investors very nervous. Global stocks tumbled on Wednesday as the stability of the U.S. subprime lending market and other credit issues came into question, and the fallout from the collapse of two large hedge funds managed by Bear Stearns rattled nerves as well. So, does the turbulence serve as a sign of even rougher waters ahead? Or are there enough positive indicators to calm investor fears? Well, joining me tonight to debate that, to my left, Liz Alderman, business editor at the International Herald Tribune. To my right, Christopher Mesnu, international corporate attorney. And again, to my left, Max Keiser, markets and finance analyst and founder of KarmaBank.com. Also, hopefully joining us later in the program via satellite from Lexington, Massachusetts, Nigel Galt, chief U.S. economist from Global Insight. In fact, I think we have them. Good sign. All right. I'll start in the studio, though, and let's begin with a look at the markets and assess how much should really be made of this week's jitters so far. Are there ominous signs here, Liz, or are these just your average corrections?
Well, this correction is not quite as bad as the last one we saw several months ago back in February and March. But that being said, I think what we're seeing here is a sort of a cumulative effect of concerns that have been growing about the subprime market in the United States. What seems to be a little bit different this time around is that some of the exposure that we have seen to the subprime market seems to be spreading just a little bit into some foreign markets. This morning, Macquarie Bank of Australia indicated that it had some exposure which caused significant jitters in the Asian market, which then filtered into the European market. Earlier this week, we saw a German bank as well signal some exposure to the U.S. market, which, you know, just fanned the nervousness. As to how long this current cycle of volatility will last, it'll probably blow over just a little bit. But the fundamental concerns will remain because as subprime woes grow, it's likely that that might start to have some effect on the American economy and consumers who are homeowners. And if that cycle starts to deepen, if we see a fundamental sort of effect on the American economy, then I think a little bit later in the year you would see even increased market volatility come back to haunt us.
And ultimately leading to what, beyond just volatility?
Well, leading to possibly a slowdown in consumption in the United States as significant numbers of homeowners who are owners of these subprime mortgages find that it's increasingly difficult for them to pay back. Again, if there's a slowing in the United States economy, that affects trade with other countries, and usually when the United States sneezes, the rest of the world catches a cold.
Okay, Christopher.
I think it's been said recently that Asia has become more and more immune to the United States sneezing, but this may very well be the crisis. If it really develops into a full-blown crisis, this may actually be the scenario where we learn that Asia is not as immune to the United States catching colds, because if in fact consumption in the United States slows down, that's going to have a material impact on Asian exports. And no matter how much Asia has developed as an autonomous economic unit, it still is largely export-driven, and to countries, in particular into the United States. So this could actually climb up the ladder and not stop simply at the U.S. subprime market.
Max, your take.
Transparency. That's a big issue. Bear Stearns, they've got a third hedge fund that's in trouble. They've said that people are not allowed to take money out. They're kind of engendering a panic over there. We don't know what these banks and investment banks are holding in the back areas of the bank. There's very little transparency going on. Fannie Mae and Freddie Mac supposedly have tens of billions of dollars of bad debt that they haven't marked to market yet. This is an issue of being marked to market. You hear this phrase all the time. What does it mean? It means, well, if you have a party and a counterparty making a deal, but there's no actual liquid market, they decide what the price is and not the market. Now the market's forcing these deals to be priced, and what they're finding is that they're not worth 100 cents on the dollar. They're worth 0 cents on the dollar. Just today, Moody's said they're going to have to look at these Alt-A mortgages and reprice them down anywhere between 10 to 100%. 10 to 100%. That's a complete obliteration. The damage done is pretty severe. You're talking several $1 trillion in damage. The volatility index is at historic highs. That'll indicate tremendous uncertainty out there in the marketplace. A lot of money being lost. The damage is pretty bad on some of the tertiary indexes that are not quoted, like the Dow Jones Index, are being wiped out. The finance indexes, the banks, Lehman Brothers, Goldman Sachs, Bear Stearns, their stocks are getting hammered. Going back to February, as I indicated back then. There's systematic structural difficulties.
Okay, I'd like to get back to the hedge funds that you were referring to in just a minute, but first let's get Nigel's take. Nigel, at the top, if you couldn't hear us, I was asking about just the basic assessment of what's been going on in the markets this week and how, if you see these as ominous signs, or are they just mere corrections, in your opinion?
Well, I think what's happening is that we have had this huge downturn in the U.S. housing market. It's continuing. There's no end in sight. There are billions of dollars in bad loans out there, and we're only just now finding out who is ultimately on the hook for those loans. And I suspect that there's plenty more bad news to come in the housing market area and in bad loans. What is also happening now is that on top of what's going on in the housing sector, we're getting a repricing of risk more broadly in the market. Risk spreads had been extremely low, unusually low by historical standards. We're now moving back towards much more normal levels. The more difficult question, the unknown question, is how far this will go, whether this is a welcome repricing of risk, which means that risk will be normally priced in future, or whether this deteriorates much, much further, takes us into a full-blown credit crunch, which ultimately requires intervention from the Federal Reserve.
What a grim prospects. All right, Max, you had a final word?
Well, I would agree with that assessment. There's a lot of risk that's not been accounted for. There's very little transparency. It's a huge issue. And once these dead bodies float to the surface, you're going to find huge dislocation. Yeah, the Fed might have to step in and adjust rates, but they can only control short-term rates. Remember, if the Fed comes in and lowers short-term rates, it does incredible damage to the value of the U.S. dollar. Then you have to ask yourself, well, what about U.S. creditors like China? Would they be willing to? Were they going to be incentivized to dump the dollar, which it could take the long rate higher, which then puts in more of a kibosh on housing. So there's a tremendous pincer movement going on in terms of how to value these securities. And it doesn't look good.
Okay, let's take a closer look now at the hedge funds that are in question. As we said, Bear Stearns watched two of their own collapse. They've now had to stop investors from pulling out of a third. Macquarie Bank has its issues as well. What does that say to all of you, really? Are huge, unregulated hedge funds finally showing how fragile and even maybe how dangerous they can really be? Liz?
Well, it's a big debate right now, particularly in the United States, as to whether hedge funds should be increasingly regulated. We're seeing quite a lot of discussion of that in the Senate and the House of Representatives. That discussion has also started to fan over here to Europe. There are a lot of arguments actually against hedge fund regulation, which is, at least according to the hedge funds, that many of the transactions actually wind up being beneficial in the long term because they wind up ultimately creating jobs, producing efficiencies within, companies, et cetera. But I think it's truly an open question as to whether it would be beneficial if we cracked down on them.
Is it, as a financial analyst yourself, does it concern you just the mere fact that we really don't know how much is out there in hedge funds? We know it's trillions of dollars, but there really is no genuine calculations as to what's ultimately at risk.
Well, I think somebody like Max actually might be better positioned to answer that question.
Well, it's fraud.